Good afternoon, everyone, and thank you for joining us on today's webinar to discuss the current state of the global oil and gas markets and to provide Yorkville's outlook for the MLP asset class. My name is Will Hershey of Yorkville Capital Management, and joining me today from Yorkville will be Portfolio Manager Jim Hugg and Founder and CIO Darren Sharinga. If you have any questions during the course of the prepared presentation, please feel free to type them into the text box in the bottom right corner of your screen. We will hold a Q&A session at the end of the call, and we'll do our best to answer everyone's questions. With that, I will turn the call over to Darren.
Thank you, Will, and thank you all for joining us for Yorkville's quarterly webinar. We'll start with a review of MLPs for the third quarter of 2016. And on the first slide here, you'll see infrastructure MLPs, the fundamentals remain strong. Yorkville created two scores at the bottom of the downturn that looked at the overall quality of fundamentals across the asset class. And the first one is our stability score, and a score of 10 means 100% of all MLPs maintained or increased distribution. So this score of 9.3 means 93% of all MLPs maintained or increased distributions in the most recent quarter. The growth score is a little easier to interpret. A score of 7.5 means on average distributions, which is the cash investors receive on a year-over-year basis, grew 7.5%, again, third quarter of 16 versus the third quarter of 15. So overall, the report card on the MLP asset class, and very specifically infrastructure MLPs, the pipelines and storage, 93% of all MLPs maintained or increased their distributions, and on average distributions grew by 7.5%. So the asset class in and of itself is looking alive and well and healthy. At least it was in the third quarter, and continues, that trend of healthiness continues. So how did the asset class MLPs perform in the third quarter relative to other high-yielding instruments that investors can put their capital in? Well, the best performing asset class for the quarter was high yield. It was up 5.5% on the quarter. The S&P 500 returned 3.9%. MLPs produced positive returns of 2.8%, and that contrasts with REITs and utilities, which were down 1.3% and 5.9% respectively. That is a reversal of trends that we've seen. Actually, REITs and utilities have held up much better than MLPs. They haven't gone through the great energy recession of 2015 that MLPs suffered, as they did in 2008 when MLPs were down, REITs were down, utilities were down, all risk assets were down. REITs and utilities have held up much better. What is similar, though, is since they've held up much better, similar to the S&P 500 valuations are looking a little rich when you look at both utilities, even more so than REITs, and we'll touch on that in a moment, relative to MLPs, as the S&P 500 right now is trading nearer the upper end of its historical trading range, whereas MLPs are clearly not. The part of ways that we value MLPs, we look at yields. Again, this is an income-producing asset class, and that's the entire structure of the master limited partnership structure. It's a pass-through vehicle similar to a REIT. The entity doesn't pay corporate income taxes. The cash flow then gets passed on to investors, and it's reflected in the form of yield. So a great way of looking at MLPs is what's my current income that I'm making. Income plus growth of income equals my total return across the asset class. So when you look at, or potential total return, when you look at the MLP universe currently of all the alternative asset classes or income-producing asset classes that investors can place their capital in today, MLPs are the highest yielding. And in a world of low interest rates and quantitative easing and negative interest rates in some countries, MLPs are one of the few bright spots. Healthy fundamentals, growth and distribution of 6.9% in the most recent quarter. If my numbers are 7.5%, sorry, in the most recent quarter. 6.9% is the current yield on the asset class. So growth and growth across the entire asset class, generally speaking, plus high yield. Next, highest yielding instrument in the United States has been high yield bonds. They're yielding 6.2%. And then you look at REITs yielding 4.3%, and utilities 3.6%, and the S&P 500 2.1%. So the same dollar invested in MLPs will produce 3.3% more income per annum than utilities, and 2.6% more income per annum than a similar dollar placed in REITs. Currently, an interesting point is the previous slide showed high yield and specifically MLP high yield bonds and investment grade bonds have held up very well through the course of 2016, meaning the price has appreciated, the yields have come down. Even recently, as we've seen some volatility in the MLP market and in the energy market more generally around OPEC and the uncertainty around a freeze and how that gets resolved, if it gets resolved at all. We've seen volatility, price of oil has come down from its peak. Energy stocks have come down. MLPs have been under some pressure of late. The one area that hasn't been under pressure has been actually MLP fixed income. It's held up very well. So that's generally a good indication of the overall fundamentals of the asset class being very stable. So historical yields, we looked at this because it's important, again, from a valuation perspective. I was once told in investing, right bought, half sold. If the price you pay for an asset more than anything determines the return that you'll receive from it. And so, again, using yield is a good proxy for valuations, high yields being cheaper, lower yields being more expensive in this case. If you look at the three lines here over time, you'll see that MLPs are trading here at 7.2% above their historical average, well off their low point achieved back in 2014 in terms of valuation levels, and again back in 2007, peak points in the MLP market. You look at utilities, which is on the right-hand side, the lowest line at 3.4%. Utilities right now, outside of where they traded, again, back in 2008, are pretty close to their all-time lows. They're not quite there. They're a little off it. And then similarly with REITs, you're closer to your all-time lows than your all-time highs, but again, not quite at the bottom, just nearer the bottom than the top. And on MLPs, there's still quite a bit of room for yields to move lower, which means if income doesn't grow, which it is growing, price would have to appreciate to bring yields lower. So on a relative basis, MLPs appear to be cheaper, a better value at this point in the cycle than either REITs or utilities when we look at yield as a metric for valuation. One of the themes on the call, and a question that we're often asked and addressing from both institutional investors as well as individual investors, what is going on in a macro level? What do you see when you look out at the global energy markets? And we've stated this on calls earlier. The difference between 2008, the Great Recession of our lives, we all hope, and then 2015, which was the Great Energy Recession, which mirrored in magnitude the 2008 recession, but only for energy companies. In 2008, we had demand destruction, which drove energy prices down. In 2015, and caused, in 08, again, demand destruction, drove energy prices down because we were in an oversupplied situation on a global basis. In 2015, in the great energy recession, we had oversupply, and the oversupply primarily came from the United States, from our unconventional shale plays that were the growth area on a global basis of new production caused to oversupply. So one was demand-driven problems, and this time in 2015 were supply-driven problems. So the rebalancing of the global oil markets is very important. The question isn't so much demand at this point. The question is supply. What's going on with supply? Well, we've already seen the United States. We've mentioned this in previous calls. We've seen production come in over 1 million barrels a day in the United States. So the primary rebalancer of the global oversupply has been the U.S. The numbers are roughly 1.2 million barrels per day from peak production through current production levels. The second part of the equation now becomes the OPEC's potential freeze, which would actually be a freeze and a cut. Let's just examine this for a moment, because if that happens, it would be good for energy prices, because it would immediately, by cutting supply, bring the markets into balance, or at least the perception of markets being in balance, which would be very good for oil prices. So OPEC currently, and we published an article on this, a research report in our most recent MLP beat, so it's available on our website at yorkvillecapital.com under research and then under MLP beat. So for more information, please look there. Anyway, one of the theses in the themes that we've been talking about through the great energy recession of 2015 and OPEC moving towards free markets and allowing the oil price to settle where the oil price wanted to settle, which was at $26 at its low back in February of this year. OPEC had been incentivized, was our thesis, OPEC had been incentivized, and oil-producing nations were incentivized and needed to produce at maximum levels. And why would they do that with oil prices being low? Because they need hard currency. Oil is such an important part of their overall economy and balancing the budget that as oil prices dropped, their need for currency didn't drop. So they were still spending the same amount of money, but they weren't generating the same amount of money from oil revenues. So what did that do? That incentivized them to maximize production levels. As you can see right now, when OPEC's talking of a freeze, they're talking of a freeze overall at levels that they've never produced at going back to the 1990s. So these are record levels of production coming out of OPEC, not record levels of production coming out of every member state or nation that is part of OPEC. But overall, OPEC is producing at maximum levels. Again, they were incentivized to do that because of budget deficits and the need for hard currency. So we drill down a little deeper into not just total production levels on this next slide, but we actually break it down by country. And as you can see from the top, UAE, Saudi Arabia, Kuwait, Ecuador, Iran, and Iraq are all producing above 90%. And in fact, the top three are almost producing at record levels, and so producing 100% of peak production ever from these countries. So a second thesis that Yorkville's held to and contends is that the idea that there's a lot of latent supply of oil to come back on from oil-producing nations doesn't seem to ring true to us based on the reality of the situation and a few other facts that we've seen come into play. One is that they're producing at peak levels. Generally speaking, if your factory is operating at 100% of its maximum capacity ever, that doesn't mean you have a lot of capacity left to bring online. So that's the first sign. The second sign, and part of our thesis, would be that there's been an underinvestment in exploration and production. on a global basis, given that, and why? Because oil prices got down to $26 at the beginning of this year. So that has caused a lack of capital formation around the oil patch. And that's not just in the United States, that's on a global basis. So what we found this past year is that new reserves discovered in 2016 were at 70-year lows, which is shocking because the entire consumption on a global basis was 1/5 of what it was today, roughly, when you go back 70 years ago. So the fact that we only discovered as many new resources as we did back in the 50s is really shocking. And so there's been, so the second part of our thesis is there's been an underinvestment in producing assets going forward, which will ultimately lead to a deficit because assets are declining assets, energy assets are declining assets over time. So that's the second part of our thesis. And then the third part is that in 2018, it is a known fact that new projects that are coming online, some big projects that are multi-billion-dollar projects, the last ones are coming online this year, next year, sorry, 2017. In 2018, due to the lack of investment in the previous 3 years, that's roughly how long it takes to bring a new field online, a new major field. There's been no investment in new fields. So 2018, there's definitely a structural gap on the supply side that will need to be filled. So it's just a question of not are the markets rebalancing from a supply perspective. Yes, they are rebalancing. Some pundits believe they've rebalanced already and are back in balance, and that occurred in the third quarter. Others believe it will happen in the beginning of 2017. At some point, given the nature of the declining declining production from any given well over time, the markets will come back into balance, and definitely by 2018 there's a structural gap that will happen. So when we look at production levels, peak production levels by nation, you see that the majority of production coming out of OPEC are producing at or near record levels. So, and then the countries near the bottom, there are real issues around the countries structurally on whether they'd ever be able to achieve maximum levels of production again. In our most recent MLPB, we analyzed a second piece of data, and this comes from the IMF. And the IMF looked at the oil prices that, again, oil-producing economies would need, and a lot of them are OPEC members, in order to balance their budgets. And as you can see, at the extreme end is Libya would need $200 oil. Our thesis is not peak oil anymore. Our thesis for the price of oil is lower for longer, and I'll talk about some trading ranges in a moment. And at the low end would be Kuwait at $52 per barrel they break even. The number that's interesting to me and to us as a firm is really the 66.70, which sounds like a very precise number. Again, it comes from the IMF, but roughly $66, $67 per barrel is what it would take Saudi Arabia to break even, the responsible for a third of the production out of OPEC. So what is the goal of OPEC? Well, it is to find an oil price that ultimately balances their budgets. And so, unlike the U.S., which is a capital market, will be driven by the price of oil and will ultimately be price takers. OPEC has a different mandate, is we need to balance our budgets through our oil revenues. So instead of the U.S. being the cheapest producer will win, they'll be the first to come back on because they can make money by producing it more efficiently for lower costs and make money in lower oil environments. For OPEC, really what price of oil is needed to balance the budget. So looking at expectations, Saudi Arabia, again, would be between the $66, $67 per barrel range, and nothing under 50 works for any country. So oil prices today, the takeaway here, we believe the range is 40 to 60. Where we are currently, 50 to 60 if OPEC comes in with a cut, and then in 2018, all things being equal, prices move higher from there. So that is sort of our synopsis on OPEC. Now, do we think OPEC comes to an agreement? We don't know. I mean, it's impossible to tell. They failed once already this year to come to an agreement. This is the second time they're coming to the table. We're uncertain whether any agreement comes out, but I think the takeaway for you and for all investors is it really doesn't matter. The markets are rebalancing organically. I'm sure you've heard this. The best solution to cheap oil is cheap oil. So the fact of the matter is, if oil remains at $40, $50 per barrel, the amount of investment in new production will be relatively limited and muted on a global basis. It means production levels will ultimately continue to drop from depleting assets, and prices will go back up, encouraging production. In the United States, what you've seen from the lows in this price range, $40 to $50, there's a lot of basins that make money and a lot of areas within the country that are able to produce oil highly profitably at these levels. And part of our job as investors is to be producing or to be selecting companies and partnerships with exposure to these basins that where E&P companies, exploration and production companies can profitably produce oil in a $40 to $50 range, which is probably a reasonable assumption whether OPEC does anything or not. So we don't know what OPEC does. We think the larger theme of supply overhang here is taking care of itself. There's a chance it already could be in balance. If not, over the next half a year, the markets come in balance. And if OPEC does get involved, I think there's more risk to the upside at this stage, which to us is reward. That's not risk. But in oil pricing, I've heard as much as $15 per barrel could be priced in OPEC. Again, we think 40 to 60 is a range, and that 50 to 60 would be a range if OPEC comes in with a cut. But again, these are to predict oil prices is really very difficult. So those are our best guess those are our guesses at best. So the global supply and demand, I've spent a lot of time on this, and this is sort of in conclusion. This comes out of Energy Intelligence Group. This chart, it goes back to May of 2015, and it's just looking at the oversupply. So 0 is near the bottom, and -1, and these are measured in millions of barrels of supply and demand imbalance. As you can see from 15, we've been as high as 3 million barrels of oversupply, and starting here in June and a couple of times it's dipped below that. It's a volatile number, again, hard to estimate what demand is on a global basis. Supply is easier, and even that's not that easy. So the point is it's trending in the right direction, and given all the points we just made, it will continue to trend and will rebalance if at some point here in the near future, we believe. So there's another theme that we believe at Yorkville is being overlooked by a lot of investors, and it provides us with an opportunity to profit while others are or potentially profit from it, and that's natural gas. It says here the bull case. The real energy revolution that happened in the United States wasn't an oil revolution, although that was incredible. It made us the largest oil-producing nation at our peak globally, and it's our belief we will be there again in the not too distant future, as measured by years, not quarters or months. So the biggest energy revolution was natural gas, and natural gas, we actually have 100 years of supply at current consumption rates here in the United States. And that's what drove the price from 15 down to 225, or a little over $2 per MCF. If you look at the rig counts for natural gas. That's what this chart here shows you. They peaked at 1,600, and they're now under 100. So the amount of drilling activity for natural gas has just been decimated over the past, since 2008 when natural gas peaked at 15. So part of it is so ultimately, if there's no drilling, natural gas is a byproduct of oil too, so it's not a complete picture. I don't want to be misleading here, but again, not a lot of drilling for natural gas. So the supply side of natural gas has been relatively muted or hurt a lot more even than oil, as you can see from rig counts. And at the same time, given the amount of natural gas that the United States has, and they again lower longer, the belief that natural gas prices will remain some of the cheapest in the world for the foreseeable future, given the amount of supply that we have, there's been a lot of building of petrochemical plants along the Gulf Coast. We've started to see them come on 15, 16, and into 17, and the biggest sort of amount of demand is coming on now and into 17 for the feedstock of natural gas. So their natural gas pricing is it's a commodity that historically has been geographically limited because it doesn't transport on ships like oil does. Recently with LNG, liquefied natural gas, and with Cheniere, who we have a position in Cheniere, an investment that they were the first to ship liquefied natural gas from the United States to other countries. So, but outside of that, it's really local demand. So a lot of natural gas is contingent upon weather, which is a primary driver of pricing. In the winter, natural gas prices go up seasonally, more demand for natural gas, and then they come down in sort of the fall and spring when demand isn't as high. So natural gas pricing, given the lack of drilling activity around it, is witnessed by rig counts and new demand sources coming online. If you look back in February, natural gas was under $1.70 per MCF, sort of moved up to a little under $2 in May, and since then it's gone from $2 to it's shown a little volatility of late, but around the $3 level, and been holding and looks to be headed higher based on supply and demand fundamentals going forward. And next year we've seen estimates as high as $4 and per MCF for natural gas. So natural gas is another area where finding partnerships that are focused in the right fields, that are the low-cost producers, that will need more fractionation of nat gas to its component pieces, which become feedstocks for petrochemical plants, is really good for a lot of gatherers and processors. It increases volume, it increases on both sides for natural gas as well as natural gas liquids, and it increases their fractionation margins as well. So there are a lot of opportunities going on under the surface of whether OPEC cuts or doesn't cut, and what's going on with oil prices. So there are still opportunities for growth within the U.S. oil field. So how's Yorkville fared in the midst of everything that's going on for this year? Again, if you look at our core income strategy, it's driven by the concept of fundamental alpha, and as a reminder, fundamental alpha is we will own a company and hold a company as long as they are not, or we do not believe there's a risk of them cutting their distribution at a minimum, and then we look for, because we view MLPs as a total return investment strategy, we're looking for MLPs in the strategy that are exhibiting above average growth rates across their businesses. And so that's called fundamental alpha. So what you'd expect to see from us, our stability scores in the 10 range, which means 100% of the names in our portfolio have maintained or increased distribution, and that's where we stand in the most recent quarter. The gross score of distributions across the portfolio has been 6.3% in the most recent quarter. So 100% of the names have maintained or increased distributions, and they show a distribution growth rate of 6.3%. Moving forward, if you look at our current yield as of 9/30, which again is for the third quarter, we are showing 5.8% in the core income strategy, slightly below the Yorkville MLP Universe Index, which is a market cap weighted index of all master limited partnerships. So it's inclusive of 100% of the entire population. A yield slightly below that of the index, 7 versus 5.8%. Our year-over-year distribution growth rate, that explains the lower yield. The MLP Universe Index, unlike just the infrastructure names, contains exploration and production companies, coal companies, marine transportation, E&P companies, coal companies. Both, until recently, E&P more specifically, have been under a lot of pressure. They have cut distributions. Some have filed for bankruptcy and restructuring, reorganization. It's been an area of MLPs outside of the infrastructure that's been under a lot of pressure. That's why overall you see a negative growth rate here. This is not just infrastructure MLPs, but looks at the entire universe. And relative, since our portfolio invests in the universe, 70% again structurally will be in infrastructure names, and 30% will be and where we think are opportunistic investments that may or may not be outside of the infrastructure. So we use this as our most reasonable benchmark comparison. So we were up 6.3% in terms of distribution growth versus negative for the index. Excuse me. Our wrapping up here, getting down to performance, where the rubber meets the road. So for the third quarter, our investors have benefited. MLPs essentially have been flat from June through through the third quarter. Let me just stay on topic here for the prepared remarks. We had a wonderful quarter, up 9% gross, 8.2% net, versus 1.1% for Alarian. So that's on a net basis, 700 basis point or 7% of outperformance delivered in one quarter. On a year-to-date basis, the Alarian MLP index, which is the most widely followed index, is up 15.9%. So let's just round that to 16% versus 21% for the MLP core income strategy. So delivering outperformance over the benchmark index of 5%. That's a big change. If you remember, for our clients from previous calls, we'd actually been lagging the index over the last little while. A big part of that has been growth. MLPs have been out of favor as the market turned in February, and low yielding or high yielding names that were priced for bankruptcy looked like they were going to survive, and actually now have survived, and we're going to cut distributions as what drew investors in initially. Those were the companies that outperformed, high quality, as defined by MLPs, that had faster growth rates, lower income or lower yields, and generally better balance sheets, have underperformed as investors have opted out, as they often do in a recovery for high income, by the cheapest names that have been arguably mispriced, and then ultimately you'll see a migration back to growth. So we're caught a little bit in the underperformance of our style growth. We've growth hasn't come back as radically as we have, or as rapidly as Yorkville has. So that's a little bit of that is positioning of the portfolios we've discussed, and superior security selection that's driven the performance in Q3 and brought us to a point of, again, delivering alpha over the benchmark. Finally, and this is just looking at our longer-term performance on a one-year basis, you can see, again, we're starting to deliver alpha on a gross net relative to Alerian, and then over every other time frame, 3-year, 5-year, or inception to date, you can see that we are delivering significant amounts of alpha over Alerian. So it has been a challenging environment. 2015 for a lot of our investors, we're appreciative of the support. The interesting 2008 versus 2015, again, demand destruction and oversupply in 2015. Both had led to really bad environments, catastrophic environments for energy stocks and oil prices. We have started to see the bottom, or the current bottom, put in at February 11th, and prices coming back again. The one difference here, when we look at 2016 relative to 2009, in 2009 MLPs were up for the year almost 90%. And this year, when you look at Alerian's returns on a year-to-date basis, it's 16%. So MLPs have not run as far as they have in the past. Oil prices haven't popped as fast either as they did in 2009. Still, we see a lot of room, for MLPs to get back to where they were trading, not even moving to new highs as many other asset classes are in North America. So we like where we are currently, and that wraps up my formal remarks. We're gonna turn it back to Will to open it up for Q&A.
Great. Thank you, Darren, for the informative presentation. With that, we'll now begin the Q&A portion of the call. As a reminder, we already have some in there, but please type your questions that you'd like addressed in the bottom right corner of your screen. And we have a couple, so why don't we get started? Jim, if you don't mind, we'll give Darren a break.
Sure.
With the first question here. What are your thoughts on the likely outcome of the Dakota Access Pipeline? And with that outcome, what do you see the impact being overall on the MLP asset class?
Well, I think eventually, and at Yorkville, we thought this was going to be resolved a lot sooner. But if you look at the history of this, going back 3 or 4 weeks, a judge had signed off on this. I don't know whether it was a judge that was appointed by President Obama or by Bush or by whom, but and at the last second, the Justice Department came in, which really surprised a lot of people, us included. I think that perhaps after the election, they're going to come to some resolution. We thought it was going to happen beforehand, but it's our understanding that the pipeline, DAPL, continue to work to complete it, but there's just one stretch that is not on Native American ground. I think that the Native Americans have been protesting, but I think it's, and our friends in North Dakota could probably comment on this, but I think it's it may be on certain burial grounds or sacred grounds. That's what first came out about this, and then the environmentalists joined the Native Americans, and this is what has caused the disruption. But there's been, I think, too much invested. I mean, something like $3 billion, and I think that it's one thing to block a keystone, but this really just has a little bit more to go for it to be completed, and I think it's too important for the government to to hold this up. So we're sanguine, but it's going to take a little bit longer than we thought.
Great, thank you, Jim. Darren, this one for you, and you already started to allude to it with some of your comments on natural gas, but which MLP sectors do you feel have currently the greatest upside from where we stand in the market?
Okay. One of the trends that has happened in positioning the portfolio over the course of 2016 has really been moving from a very defensive posture, which was to have 100% of the portfolio invested in infrastructure MLPs that were backed by long-term contracts. We like all of these things. Please don't get me wrong. We still look for all of those in our investments and in our current portfolio, backed by long-term contracts, as far removed from the wellhead as possible. And part of that brought us at this point into I'm going back in history, not currently, brought us into your refined products, which did very well in refiners up until recently. So that was the security, far away from the wellhead as possible, closer to distribution. Refined products, demand for energy and gasoline was at all-time high. Miles driven were at record levels. So that was a good place to be to position the portfolio for safety. As we started to see new facts come through, and the most important fact is the rebalancing of the global energy markets, that we were able to start getting comfortable that February 11th was actually the bottom. $26 was the bottom of oil. And so over the course of the year and reflected in performance of late, we've moved closer to the wellhead. Now, having said that, this portfolio we're talking about is still 100% invested in companies that have long-term contracts. In infrastructure names, infrastructure MLPs, the one exception would be a shipping company, so not quite 100%, north of 90% invested in infrastructure names. And we've moved more towards gathering and processing. So when I look for an area that is going to benefit from a turn from decreased production and moving into increased production, gathering and processing is one of the areas. Now, gathering and processing is close to the wellhead again. So we moved away from the wellhead. Now we're moving back towards the wellhead in the gathering and processing sector. And actually, I was wrong. There's another area when I look at it is the second area as we move closer to the wellhead was into frac sand names, Submerged Energy Services, as well as High Crush, which are they produce proppant that helps with not only on drilling but completion of wells, which is really when you're using that to stimulate production. So those have been the trends. I don't think that gathering and processing alike, you need to be in the right areas for growth. The low-cost producing regions, so you want to make sure you understand your assets and the asset footprint. And then oil field services, I don't think that this is a gangbuster time where everything's going to do well. I think that uniquely positioned our frac sand makers, because as drill rigs get redeployed, there are a little over 100 from the bottom that have been put back to work. Recently, the first beneficiary are the frac sand manufacturers. And so we think they are uniquely positioned to benefit in the early part of the cycle and have a lot of upside in them. And on that note, Will, you can comment on this. Is there not an IPO plan for frac sand company?
Yeah, it's actually this Friday. Smart Sand, not structured as an MLP, but there will be a frac sand company coming to market. But I think the general theme, correct me if I'm wrong, is the places where you have more upside is where you have more operating leverage, where you're not currently at full utilization, maybe where you're in a basin that still has a lot of room to the upside relative to where it may be going or where it once was, whether that's via sand usage or pipeline usage.
Right.
The next question here, and Jim, I'll let you handle this one. Do you see further room for consolidation in the midstream and or MLP space? We've seen some increased M&A activity of late.
Yes, I think you're going to continue to, to see some consolidation. I mean, this really started in a major way over a year ago with the Kinder Morgan deal, where Kinder Morgan Inc. took over the partnership, KMP, Kinder Morgan Partners. The work we've done, and we just think that it does make sense in certain instances. We saw that earlier this summer, Enterprise, ETE, Energy Transfer Equity, I guess it goes back to earlier this year, made a run at Williams, and that deal unraveled for reasons that we can get into. And then earlier this summer, it was rumored, it wasn't rumored, it turned out to be a true rumor, that EPD, Enterprise Products, had some very preliminary talks with Williams. So I think this is I don't think you're going to see massive consolidation, but where it does make sense and where there are synergies, I think you are going to see things like that, happen. Yes, we will continue to see consolidation, and where it does make sense.
Yeah, I think you bring up a good point. It really all started with the failed ETE-WMB proposed merger. Since then, we've obviously had Spectra and Enbridge combine liquids along with gas to create what will be one of the largest energy infrastructure play in North America by enterprise value. We've also seen another Canadian company, TransCanada, go after Columbia Pipeline in their merger. And we've also started to see some smaller deals. We saw two ArcLight companies, JPEP and AMID, just announced their merger. We saw Cheniere announce the roll-up of one of its underlying entities, along with Energy Transfer taking a stake in Pentex, and Buckeye taking a stake in VTTI. So there's been a ton of activity of late, and I think it's a matter of maintaining scale and the ability to weather a potential downturn if you're focused solely on, for example, refined products. Now you have a natural gas part of your business where you maybe get a bump up in your credit rating, you get new investor base coming into the market. And on top of that, we have continued to see roll-ups by general partners of their underlying MLPs, which have generally been well received by the market, getting rid of the IDR burden. And we've seen talks of that with MPLX as well. So there continues to be a fair bit of activity.
One further comment on this is when I look at it's sort of the progression over the course of 2016. The beginning of the year was capital market activity was focused around shoring up balance sheets, and it really was a survival move at that point, and in making sure that your partnership would survive a further downturn. And what I'm seeing now, the shift is a shift towards growth opportunities. Where are the future growth opportunities within the space? And the other area that I look at that supports that, instead of all of these activities, the enterprise family, all three of the
Energy
Transfer, all three of the subsidiaries have done capital market activities or transactions post the Williams deal, looking for further growth going forward. And then thoughts on GE, Baker Hughes, not specifically in the MLP space, but clearly a huge deal in energy. What do you think of that, Jim?
Well, I think that someone said that was a call that oil had hit the bottom. Well, that wasn't quite accurate, but the folks at GE are pretty darn smart, and I don't think they would have entered into a deal of this size unless they had quite a bit of confidence that that the outlook for energy was positive. I mean, it's an enormous deal for Baker Hughes, obviously, but it's not an insignificant deal for GE, and I think that it was very encouraging to see this. The market at first blush was, Baker Hughes had moved up quite a bit when news of the talks had gotten public, but then I think once the deal was announced, the stock backed off a bit. But I think that it's a positive thing when you see a powerhouse and then with a company with such a large capitalization, forms a partnership with a company with a corporation like Baker Hughes. We were quite. We took it as quite positive.
Thank you, Jim. Next question here. We'll take a few more before we come up on the end of the hour. Darren, for you, do you see any fundamental damage being done to the industry, the MLP asset class, if rates keep moving higher?
No, and I don't. We published a white paper probably a couple of years ago now, which was an extensive look at how MLPs performed in rising interest rate environments. And we looked at both when it was the 10-year interest rate was moving, which is indicative of strong economic cycle and inflationary expectations coming in, moving 10-year rates, as well as Fed-driven, raising the short-term interest rate. And in both cases, MLPs over the course of tightening cycles produce positive returns. So we don't see it doing any structural damage to MLPs, number one, and it hasn't historically. We don't think it will now. Why? Primarily for the two scores that we produce in the growth score. MLPs, unlike fixed income instruments, are growing their distribution. These are really growth equities, and that's what differentiates MLPs from high yield bonds. Although their yields are similar right now, in fact, MLPs are producing higher yields, they're growing their distribution. That growth of distribution is a hedge, is protection against rising interest rates, and so that is the primary difference. And if I had to deal with today, even more specifically than just in general, spreads are wider than they ever have been for MLPs. Hold on, not than they ever have been. And spreads have peaked larger. Spreads right now are pretty wide, and so given at their elevated levels, this gives even a little more protection for MLPs relative to rising interest rates before spreads start to hit against levels of resistance. So no, we're not as a firm overly concerned with rising interest rates. But I think that answers.
Yeah, no, I think MLPs with a 500 basis point cushion relative to the 10-year versus utilities with about 100 and REITs 200 may explain some of the underperformance you've seen in those securities if rates have started to rise relative to the MLPs.
I think too, just to add one other thing. I think that the rate hike that, and I forget what the odds are now that people are factoring in. What is it, 70 or 80%? But whatever it is, it's only going to be a quarter of a point, and that's really not going to, affect the cash flow, the present value of the cash flow that's going to be coming out, from stocks or MLPs. And as Darren said, we really view MLPs as growth entities anyway, but a quarter of a point's not going to do anything.
Mm-hmm. we'll have a little bit of fun here, given that we're less than a week away from the exciting upcoming election.
Jim, behave.
Yeah.
Jim, what do you see? what do you see? What do you see, if any, impact coming out of the election in terms of MLPs? Do you see the potential for the tax code being revised under either new regime, and how should we kind of look at the outcome?
I'm going to give an answer similar to what Darren had about the interest rates, and it was a one-word answer, no, but I'll elaborate on that. Yeah, we want to be apolitical here, so please do not take any of the following comments as an endorsement of either candidate. But you know, as far as the changing, any change in the tax code, we've kind of gone down this, and we've discussed this on previous conference calls. And just to give a very, very brief history, the MLPs were really created back in 1987. The legislation was passed, and then updated or revised in 1988. And basically what it did was it gave an advantage to energy MLPs, and it significantly lowered their cost of capital, and so it really worked. And we have you know, tens of thousands of pipelines crossing the country and storage facilities and so on, many of which probably would probably not have been built had it not been for this legislation. And again, as far as changing the tax laws, you know, right now, drilling takes place in a number of states. It used to be that, you know, 25 years ago, you could point to Texas, Oklahoma, Louisiana, and a few other states, but now there's significant drilling in Pennsylvania and Ohio and, of course, North Dakota. So I think any legislation that would be harmful to drilling activity and therefore MLPs and infrastructure, I think would be very, very difficult to you know, get through Congress. There are just too many senators and House members whose states are, you know, are effective. And finally, the amount of money that would be raised in changing the tax laws and forcing MLPs to become C corps, is maybe $3 to $5 billion. I think would be the additional revenue, which is de minimis. I mean, I never thought, you know, you'd put $3 to $5 billion in de minimis in the same sentence, but you know, here we are with a debt of $20 trillion. So from that standpoint, I really don't think there's going to be any changes in the tax laws. If you want, I can comment very briefly on you know, whose energy policies might be good or bad for energy stock, and again for MLPs, and that is that from what I can gather, you know, Donald Trump is 100% behind fracking. And Hillary Clinton has, during the campaign, has made a number of comments that she wants to restrict fracking, particularly on public lands, and wants to have a lot of restrictions even on private land. So I think we can draw our conclusions as to whose policies, at least in energy, we'll leave aside other things, but at least for energy, I think that Mr. Trump's policies would be more favorable to energy and to MLP specifically.
Okay, I think thank you, Jim. We'll end it on that question as we're coming up on 3 p.m. Eastern time here. Thank you, everyone, for joining us on today's call. As a reminder, if you missed part of the call or if you want to forward it to any colleagues, a replay of the webinar will be available on our website in the coming days at www.yorkvillecapital.com. So once again, thank you, and we look forward to speaking to you next quarter. Thank you.